Silver just did something it has only done two other times in modern history. That is the story. That is the setup. And if you understand what followed those last two explosions, you will understand why the next few weeks could shape this market for years. Because the last time silver moved like this, one case ended in a final euphoric surge and a brutal collapse. The other ended in a long, grinding period that punished anyone expecting instant continuation. Same kind of signal, two completely different endings. And now, January 2026 has just placed silver into that same rare historical category again. This is not a normal rally. This is not routine volatility. This is not the kind of move you brush off by saying metals are just having a good month. Silver has gone vertical. The chart is bending upward so hard that it now resembles the exact type of structure that only appears when a market is entering its most emotional phase. That is why this matters. Not because it looks impressive, because it changes what kind of market you are dealing with. In the last 52 years, silver has only posted a monthly surge of this size two times before. Once in 1974, once in 1979, and now again in January 2026. That is the entire point of this video. We are not talking about something common. We are talking about an event so rare that most investors will live through it once and still fail to recognize what they are seeing. They will just stare at the candles, react to headlines, and convince themselves this time is simple. It is not simple. It is historic. Silver has now surged roughly 270% in about a year, and January alone delivered a move that belongs in the record books. When a market starts behaving like this, it stops rewarding casual thinking. It starts rewarding discipline, context, and emotional control. Because this is the stage where fortunes can multiply fast, but it is also the stage where people give back life-changing gains simply because they do not understand where they are in the cycle. That is what a parabolic move really is. It is a market rising so fast that normal pullbacks disappear. Price does not climb. It accelerates. It begins to feed on itself. Every breakout attracts new buyers. Every new high creates fresh excitement. Every dip gets bought before fear has time to spread. The chart starts to look unstoppable. And that is exactly why parabolic phases are so dangerous. They make continuation feel obvious right before the structure becomes fragile. People love the beginning of a parabola. Almost nobody handles the end of one correctly. So let's go back to the first major case that matters here. December 1979. Silver had already been running hard. Inflation was eating into confidence. Faith in paper money was weak. Speculative fever was growing. Large players were building enormous positions. The public was becoming aware. And then silver delivered a monthly move so violent that it forced itself into financial history. 65% in 1 month. The exact type of blast we just witnessed. Now here is the part most people need to hear very carefully. After that giant monthly surge, silver did not peak immediately. It kept going. January 1980 came in and poured gasoline on the fire. Price pushed dramatically higher again. The move after the signal was not small. It was not modest. It was another wave of upside that made everyone feel brilliant for staying bullish. That is how late-stage manias work. They do not usually end with a polite warning. They end by making the crowd feel more correct than ever, right before the trap closes. Silver then topped near $50 in January 1980, and what followed was devastating. Not a calm reset, not a healthy retracement, a collapse, a violent unraveling that crushed leveraged traders, punished late buyers, and burned itself into the memory of the market for decades. That high stood as the defining ceiling for nearly half a century. Think about how powerful that is. One euphoric ending created a psychological scar that the market carried for 45 years. That is outcome number one. Historic monthly surge, follow-through upside, emotional blow-off, then devastation. Now let's go to the other case. February 1974. Once again, silver exploded higher in a single month. Once again, the move was extraordinary. Once again, the public had every reason to believe the next step would be another straight-line continuation. But this time, the market chose a different form of pain. It did not reward the crowd with a spectacular second launch. It did not crash instantly either. It did something slower, and in many ways crueler. It went sideways. For years. That is what makes this comparison so important. The same kind of rare monthly expansion produced a completely different outcome. Instead of a fast, euphoric ending, silver entered a drawn-out consolidation that lasted roughly 5 years. 5 years of stalls. 5 years of boredom, 5 years of watching momentum disappear, 5 years of emotional exhaustion for anyone who expected immediate riches. The people who lacked patience walked away. The people who needed excitement quit. And only much later did silver finally break free and deliver the explosive upside that history remembers. So here we are now with the third occurrence unfolding in real time. January 2026 has already delivered the rare signal. The market has already entered the zone where history says the next move matters enormously. And that leaves us with one brutal question. Which version is this? Are we standing in a 1979-style acceleration that still has one final manic push left before a major top? Or are we in a 1974-style setup, where the market needs to digest this move through a long, frustrating range before the next giant leg higher comes later? That question is the whole game now. Because if this is behaving more like late 1979, then February could still produce another major upside burst before the market reaches a dangerous emotional extreme. And if that happens, the very move that looks most bullish on the surface may actually be the one investors should fear the most. That is the paradox of parabolic markets. The final run feels like confirmation, but it is often exhaustion disguised as strength. Let's walk through the math. Silver is trading around the low 100s after massive volatility. If February were to mirror the type of follow-through seen after the 1979 signal, another 35 to 40% surge from this region would place silver roughly in the 150 to 160 area. That is not a fantasy number. That is not random hype. That is what the structure suggests if the historical analog continues for one more phase. And if silver reaches that zone fast, everything changes. At 150 to 160, momentum would likely be stretched to an extreme. Sentiment would probably become euphoric. Every headline would get louder. Every prediction would become more reckless. People who ignored silver at 40 would suddenly be demanding silver at 150. People who mocked the move would panic and chase it. Influencers would call for 200, 300, maybe even more, because that is what happens near emotional extremes. Price moving higher does not create clarity. It creates delusion. That is why the 150 to 160 area matters so much. Not because it must be the exact top, but because it is the kind of zone where a parabolic phase can become terminal. It is the kind of zone where smart investors start asking not how much more they can make, but how much they can protect. In these moments, the most dangerous voice in your head is the one telling you that selling anything would be foolish because the market looks unstoppable. That same voice has ruined people in every cycle. But now, let's be fair to the other scenario, because ignoring it would be just as reckless. If this plays more like 1974, then silver may not give the crowd a glorious second burst. It may simply refuse to behave dramatically in the way people expect. It may cool down, shake out leverage, and enter a prolonged period of frustrating consolidation. Not because the bull case is dead, because markets often need time after a historic acceleration, and time can be just as punishing as price. A 5-year range sounds harmless until you live through it. It means every rally starts to feel suspicious. Every dip feels heavy. Conviction decays. Media attention disappears. New narratives take over. People stop caring. Many sell not because they are terrified, but because they are tired. That is the sneaky damage of a long consolidation. It does not usually destroy you in one dramatic move. It drains you slowly. It makes you doubt what you once believed. It gets you to leave right before the next real opportunity appears. So which path looks more likely right now? My own reading is that this structure leans more toward the 1979 type than the 1974 type, mainly because of the speed of the move, the intensity of public attention, and the emotional character of the price action. This rally has not felt calm. It has felt urgent. It has felt unstable. It has felt like the kind of market that is feeding on momentum and narrative at the same time. That is why I believe a final upside spike remains possible. But belief is not certainty, and that distinction matters. Nobody knows the exact top in advance. Nobody. Not analysts, not funds, not people who sound confident on camera. Markets reveal tops after the fact. The job is not to predict the precise candle. The job is to understand the range of likely outcomes and prepare before emotions take control. That is what separates process from gambling. So here is the practical framework. If silver breaks higher cleanly and starts racing toward 140, 150, 160, that is the area where risk management becomes essential. Not panic, not all-out liquidation. Discipline, scaling, protecting gains, reducing exposure into euphoria instead of worshiping it. Because if this does become a true blow-off phase, the exit window will not stay open for long. Late-stage rallies always look easiest right before they become impossible. Now let's talk downside, because every serious plan needs one. If the market fails to extend and instead enters a broad reset, where is the structural floor? Based on the current breakout zone and the way this cycle has built itself, I believe the major support area sits dramatically higher than what many people still imagine. The old conversations about $30 or $40 silver belong to a different regime. That market is gone. Even in a harsh correction or a drawn-out consolidation, I do not see a return to that old range as the primary expectation. The deeper value zone now appears much closer to the $60 to $70 region. That matters for two reasons. First, it tells you the floor has likely been repriced upward on a structural basis. Second, it gives long-term accumulators a framework. If the market does enter a prolonged digestion phase, weakness into that region would likely look less like a death sentence and more like an opportunity created by emotional excess washing out of the system. The whole point is that the market no longer appears to be operating on the old map. But price levels alone are not enough. The real battle now is psychological. Parabolic markets create violent swings because leverage gets involved, weak hands get shaken out, and both greed and fear intensify at the same time. You will see huge up days. You will see savage reversals. You will see candles so large they feel unreal. And if you do not have a plan, those swings will control you. You will tell yourself you are investing, but you will actually be reacting. And reactive people become fuel for disciplined people. This is how the transfer happens. Retail buys because price looks safe after a run. Then the market drops hard and they panic. They sell weakness to relieve pain. Then the market bounces and their fear turns into regret. They buy back higher because they cannot bear missing the recovery. Then volatility hits again and the cycle repeats. Buy high, sell low, re-enter high, panic low. That pattern does not happen because people are stupid. It happens because most people enter markets without a script for what they will do under emotional pressure. And emotion is the one thing this market is now manufacturing in bulk. So decide now what kind of participant you are. If you hold physical silver as long-term insurance, then daily volatility should not own your mind. Your horizon is bigger than a few violent weeks. If you are trading leveraged paper positions in a market behaving like this, then understand clearly that this is where accounts get destroyed. Not because the trend is impossible to read, but because the swings become too large for people using too much size. Volatility is not your friend if your position can force you out. If you are sitting on major gains, it makes sense to think in layers, not absolutes. You do not need to sell everything to respect risk. You do not need to hold everything to prove conviction. Taking partial profits into a potential euphoric zone is not weakness. It is professionalism. It gives you optionality. It reduces regret. It allows you to participate without becoming hostage to one outcome. If you have no position at all and are feeling panic because the move seems to be running away, that is exactly when you need to slow down. Chasing parabolic price action usually feels smartest near the worst possible moment. Small entries, patience, a defined plan. Those things are boring, but boring is how people survive long enough to benefit from extraordinary markets. And now we get to the most important part. There are really only three kinds of people watching a setup like this unfold. The first are the people who will ignore the historical context entirely. They will treat this as just another exciting chart. They will get swept into every headline, every swing, every emotional surge. They will let the market think for them. The second are the people who will become so overwhelmed by multiple scenarios that they freeze. They will wait for certainty, and certainty never comes. They will stand still while price writes the answer without them. The third group will use this moment properly. They will respect both outcomes. They will define their levels. They will know what they want to do if silver races higher. They will know what they want to do if silver falls back into a major support region. They will enter volatility with a framework instead of panic. That third group is usually the one that keeps its gains. So here is the bottom line. Silver has just done something it only did in 1974 and 1979 before now. That makes January 2026 one of the most important months in modern silver history. After one prior signal came a final surge and then a collapse that scarred the market for decades. After the other came a 5-year consolidation that wore investors down before the next major run. That is the crossroads we are standing at right now. If price continues to explode and enters the 140 to 160 region quickly, that is where this market becomes especially dangerous, because euphoria will likely peak there. If instead, silver cools off and starts building a wide range, then patience becomes the real test. In either case, emotion is the enemy. Greed will tell you risk does not matter. Fear will tell you the trend is dead. Both are trying to make decisions for you. Do not hand them the keys. And one more thing. Do not confuse excitement with certainty. The market does not ring a bell at the top, and it does not send you a polite invitation before a reset. It tests you when you feel most confident. That is why preparation matters more than prediction. Stay sharp, stay patient, and stay honest about your own risk tolerance, because the next 60 days could reward discipline in a way most years never do. Drop your view in the comments right now. Which path do you think we get from here, 1974 or 1979? And do you want the next breakdown on gold built with the same historical depth? Let me know. Subscribe and stay close because the follow-up matters. The next move in silver will not just move price. It may decide whether this entire rally becomes a legend or a trap. Silver has only done this 2 times before. Now it has done it again. And the people who understand what that means will be ready before the crowd even realizes the real decision has already begun.